of hands, how many of you love to hear the word debt? Anybody? Anybody? Anybody online raising their hands? No. No, debt stinks, right? Most of the time, it's got a bad connotation, right? We don't like debt. No one wants to be in debt. When we hear about debt, it's usually a bad thing, right? But today I want to kind of talk about how you can use debt as a tool, right? And how, if you have a problem, if you're struggling, or if there is a goal that you're wanting to accomplish in terms of debt, we look at using debt as a tool, right? Debt can be a very good thing if it's used in the right way. The biggest thing is making sure that you have control. So let's see here. I feel like I skipped one. Nope. Okay. So knowing your options as far as taking care of debt is important, right? So actively working to pay down your debt using debt wisely can make real progress on your financial wellness journey, right? Like if we don't talk about your debt, you can save all the money in the world, but if you have crippling debt, it's not going to help you, right? Knowing the strategies for paying down your debt in a manageable way, the benefits of debt consolidation and plans that might suit you. So let's talk about planning first, okay? This isn't the budgeting seminar. Who likes the word budget? We got one. Okay, that one's a little more fun than debt, but it's kind of close, right? Right. So here's the thing with budgeting. Okay, it's going to be the most important financial tool. This isn't the budgeting seminar again, so we won't get real deep on budgeting. There is one in the list that we'll get to, but this is not that. But we'll touch on it, right? A budget is a plan. It's not a punishment. Okay. A lot of people hear budget and they immediately shut down because they think this is taking things away that I love, right? This is restricting, this is the diet, right? Um, um, who can tell me why a budget fails typically? You don't have enough money. It's a good one, right? That's a good one. Okay. Who else has one? What? Yeah, you don't budget every dollar. Anyone else have one?
You go over the budget all the time.
What was that? Say it again.
You go over the budget all the time.
Yes, yes. So you go over. Yep. Perfect. So if you think about dieting and you think about budgeting, they're very similar. Okay. They fail for this kind of the same reasons. Either we're too strict with it and we don't allow things that we love in there, right? Or we're, you can be overly aggressive or you can be too lax, right? You cannot have a plan at all, right? A lot of us think about when when you get out of high school or you graduate college, you go to get your first car, right? What's determining what car you get, right? It's whatever I can afford. It's the nicest thing I can afford. Same thing. Now I go to get an apartment. What do I get? I get the nicest apartment I can afford, right? I'm just kind of letting my life take me where it goes. Well, if you do good budgeting, right, you might decide, hey, I don't want a BMW. I'm going to drive a Kia, but I'm going to have a swimming pool, right? You can prioritize. It's all about prioritizing what's important to you, what goals you want to accomplish. That's the thing you want to think about. So if there's one thing that I'll say that across the board, I've been doing this a decade, right? The biggest thing is make sure that you actually take the time to sit down, look at your money and look what it's doing for you, right? If you just take the time to even look at it, set a plan for yourself, you'll see financial improvements. You really will. So let's talk about not over restricting your budget. Okay. So if you need your Starbucks every day, how much is Starbucks? Go hands. Hannah.
Yeah, $5.
$5, right? $5 at least, right? $5 a day, and it does add up. Okay. I said $6 because inflation, right? I haven't been to Starbucks in a minute. So if you need a Starbucks, okay, it's $6 a day, I said, right? That's $2,190 a year. Okay. It's expensive when you think about it, right, Hannah? Like $2,000, you're like, oh, did that coffee taste that good, right? So, and I always tell people, think about this in terms of total cost. You always want to think of things in time, in terms of total cost. When you go buy a car, you don't want to look at a $300 payment. You want to look at, okay, the car was $15,000, right? You always want to look in at the total cost. Now here's the thing, right? Hannah, you said you need your Starbucks, right? You said you must have your Starbucks to survive, right?
Class, yeah, sure.
Right. Well, let's say I said there's no room in your budget for Starbucks. How long are you gonna stick to that budget? You're not,
Yeah.
right? So that's the other big thing. Let's be realistic, right? If it's something that you need and it's a priority in your life, like for me, a good coffee is a priority in my life. I want it at least 3 times a week, right? So I might say Monday, Wednesday, Friday, okay? I want to go get a coffee, right? Well, if I just go get it Monday, Wednesday, Friday instead of every day, that's only $930 a year. So it's a much more manageable number. I'll pay $930 for a good coffee, right? So it's just thinking of things in that term. If you never put your goals and your situation on paper, you're always at the mercy of the best choice of the moment, right? So you're going to make the decision based on right now, today, not what's my future planning. So it's really about prioritizing, right? So write down what you owe, right? Write down all the bills you owe is how you're going to start. Okay, you're going to determine how much you can realistically pay towards your debt each month. Okay, not what is my minimum payment, not what is the banks want me to pay. What's a realistic number that I could pay every month, right? That you should be actively setting your payments, not letting creditors set the payments for you. You should be deciding how much you're paying a month and what you can afford. And it should be goal-based, right? So you want to make decisions that fit in your goals and apply that money to your balances every month, right? Okay. So let's talk about paying off a loan sooner, okay? So I'm going to dispel some myths here too. Number one is that car payments are at 5% now. That's actually a great deal today. Buy this if you can get that rate, you're doing good. I don't know when this was made, but it was clearly a while ago. So let's say you go to buy that car, right? Loan amount 15,000. Okay. You've got a 60-month loan. There's 48 months remaining. You decide, hey, I can pay an additional $100 a month to get that knocked out. Okay, I'm going to save $379.55. What I hear a lot of on auto loans is people don't want to pay them off early because they think they get a prepayment. How many of you heard of that? That you get a prepayment? They get a prepayment penalty. Have any of you experienced that? So here's a thing that is something you want to ask when you take out auto loan financing. You want to ask if there is a well, really, if you take out any kind of financing, you want to know, is there a prepayment penalty on this, right? Auto loans, commonly $300. Very common for it to be a $300 fee to pay off your loan early. If you get your loan at a bank or a credit union, typically they won't have that written in. If you get it at a dealer, a lot of times the dealer will write that in. You can negotiate it off. So if you want to pay these, if you're taking an auto loan and you're like, hey, I want to pay extra and pay this off early, you can tell the dealer, make sure there's no prepayment on that loan. The reality is though, with or without a prepayment, there's two factors that really help with paying off loans early. So let's say you pay this down, okay, and according to this example, your $100 buys you a year and a month, right? You save that $379. Not only is that significant, but what else is significant about paying that vehicle off early? Especially if I'm trying to pay down debt.
Cash flow goes up by what you're paying.
Right.
So you didn't have it, you now have it because you don't have the payment anymore.
Right. I've just raised my income by, well, they're paying an extra $100, so $384 a month. That'll go a long way to paying on other debt, right? So paying this off early is kind of a double whammy, right? I'm saving a little bit of interest and I'm also getting rid of that payment sooner. Now, yeah.
save on interest there as well.
Mhm. Yep. Pretty much any type of financing. Um, Today, I'll say back in the day, there used to be loans that would charge you interest up front. With the exception of like construction loans, things like that, that's not as common now. What you generally want to think of is that you get billed by the month. However much I owed for this month is how much interest I'm paying. So whatever you can do to lower that number, that total monthly obligation is going to lower the amount of interest. That's a really good one.
You know, there's been talk specifically around student loans that they're talking about alternative ways to interest where instead of doing APR, they do origination fees. So if
Yes.
they borrow 20,000 rather than 20,000 at a certain percent interest, it's, well, you want 20,000, we give you 20,000, you pay us 25,000 flat over however long.
Yes.
So that it's technically zero interest, you just pay a fee to borrow 20,000.
Yes. So we'll definitely talk about that. So what I'll say to that, and that's a great question. That's really a fantastic question, and we'll get more into that later. And I did build in a little student loan section because Bracy did tell me you guys really had some questions about student loans, so we'll get there too. The important thing with anything on a loan that you're doing is that total cost. So you want to factor in that total cost. So for example, if I'm looking at, let's just say this was a $75,000 student loan. Okay, if I'm gonna say, okay, I owe 75,000 on this, they're gonna charge me, what did you say, 20,000 upfront?
Yeah, it's just a flat fee.
Yeah,
It's in lieu of an APR.
right. So let's say I factor in that APR, I put in whatever I think I'm gonna be able to afford, right, paying that back. Is that lower than the total cost of this with the interest, right? So is paying that fee gonna save me enough in interest that that fee is worth it, right? And the other thing you gotta think about too is how locked in is that? If I pay all that interest today, do I think the rates are gonna continue to come down? So
Is
is,
there an advantage of like the origination fee that the balance can never increase because you're
Mhm.
not being charged interest?
right. Right, so you're not being charged interest anymore, but you're making a lump up front, right? So the factors you have to consider with that is, do I think that rates are gonna come down in the future? Right? Do I think that there's gonna be forgiveness on this? So there's some factor, there's some nuance to that, but we'll get into that a little bit more. But the big thing I would say just from the top is make sure that total cost of financing, you're doing the math on that, right? Add up what the total is. If it's a 15-year loan, what's my interest cost over that 15 years, right? If you Google simple loan calculator, you can plug your loans in and see what the total cost is going to be on a compounding basis really easily, right? So definitely check that out. So let's start talking about how to pay down debt. So let's say I have a conversation with a client, and they want to start paying down their debts, right? Pretty much all of us, right? Strategy one, okay, debt avalanche, okay? Debt avalanche is when you're gonna take your highest interest bills, right? Don't think just in terms of credit card, but overall highest bills, and I'm gonna apply the majority of my money to that first, right? So with debt avalanche, let's say in this example, you have credit card A has a $5,000 balance at 19%, right? This 5,000 at 19% costs me more money than this 6,500 at 17.25, right? So I'm gonna pay more on this. I'm gonna pay more on this until it's gone, and then I'm gonna roll to the next one. So that's why it's called avalanche. So essentially, I'm gonna pay this off. I have the $150 monthly payment plus whatever I was paying extra. I can now put that on my next card, right? How many of you have done debt avalanche before? Couple of hands, couple of hands online probably.
Yes.
So debt avalanche, great way to do it. Starting with the highest interest rate, working to lowest interest rate. It can be a great way to kind of obviously snowball the debt down, right? Strategy two, okay? Strategy two is you start with the lowest amount, right? And you see a little momentum with this. So I'll start with, let's say I have $1,000 Macy's card. I've got a $5,000 Sears, Name a company that's still in business.
Yourself.
Yeah, let's say I've got a $5,000 Southwest card, right? I'm gonna start with the small $1,000 card. I'm gonna pay that off first and then apply that payment to the next one. Okay? So that's starting with the lowest amount first. So that's pretty simple, straightforward. Start with the smallest bills and roll to the larger bills, okay? And then strategy, lowest amount to the lowest overall balance. Yeah. Step 3, or strategy 3, I should say, is to take a consolidation loan. Okay. Consolidation loans are out there. There's a lot of ways to consolidate debt. We'll talk a little bit more as we get in here. But consolidating the debt, meaning, hey, I'm going to take these 5 credit cards and I'm going to roll them into one loan for you and give you a loan that's just one payment a month, right? To pay down debt.
So where's the interest, like, what are like the current interest rates? Because aren't there like different levels of interest rates based on the type of loan?
Yes, and I'll talk more about that further. You ask great questions. So we will get into that a little bit more, but yes, and depending on what type of loan, and I'll kind of help you understand from the bank's perspective, why we charge different rates for different loans, right? So yes, it does depend. So a consolidation loan typically higher than a credit card, but less than like equity line. So less than like a home equity line. So good place.
More than a credit card, less than a home equity loan?
I'm sorry, did I say that backwards? Less than a credit card.
I don't think any credit cards.
Yeah, my bad. So credit card would be the most expensive thing, right? Home equity loan on the cheaper side, this would be more than a credit card. Or less than a credit card, more than a equity loan or a car loan, right? So it kind of slots there in the middle. So it's kind of right there in the middle in the interest rate spectrum, which we'll talk about later, but thank you for correcting me also, because I definitely don't want you to think that a consolidation loan is more than a credit card. Or a $5 Starbucks gift card, online included. Hannah, you listening? All right. So what method will save me the most money? Typically,
That's a trick question.
which one will cost me the least?
Sure.
One.
Strategy 1. Okay, so we had a couple answers. Let's give it to both.
I'm just gonna.
Anyone online get it?
I didn't see a response. but-
Come on online, wake up. I'll talk loud so you hear me in your speaker. All right. Next question. I'll throw out another Starbucks card for this. Okay. What method is typically the most successful?
Number
got it.
1.
Anyone else say 2 online? Let's pick the first person that said.
There was one response. Yeah.
You say successful, you mean like, what do you mean by successful?
Generally, clients have the most success with.
Like, it's like. They pay off.
Well, yeah, like they actually pay off their debt and they're in a better situation.
That's what Dave Ramsey preaches about.
Pay off with us balance.
He's
Yeah.
good about it.
Yeah. Yeah, so say that a little louder. Why would that be more successful generally?
You feel good about it and you want to keep going to.
Exactly, right? I feel great because I paid something off. I got rid of that stupid $1,000 Macy's card and I'm ready to tackle the $5,000 Chase card, right? Yeah, it's from a mind standpoint, from a psychological standpoint, and our research matches Dave Ramsey's, right? I think he says the same thing, right? Lowest first is the better option for most consumers. Now, option A will save you more money, right? It's gonna lower your interest costs. But option B is, I shouldn't say strategy 2, right, is the most successful with clients. Why is strategy 3 not as successful?
You're limited based.
You are limited, right? Not everyone can do a consolidation loan, right?
Most people to see that.
That's another possibility. Here's another thing to think about. If I do strategy 1 or strategy 2, I'm doing this every day, right? I'm working on it every day. Sometimes the consolidation, don't get me wrong, I love doing them because they get people out of tough spots and they can save you a ton of money. The problem with the consolidation line or loan, I should say, problem with doing consolidation is it's a get out of jail free card in some ways, right? So. Right. So essentially with consolidation loans, a lot of times we'll require, but we don't always, right? A lot of times we'll require, hey, you've got to close those cards that we're paying off, right? Because we don't want them to go back up. But the reality is that if we get out of jail too easy, we reoffend, right? So if we haven't solved the underlying problem, if we haven't solved the budgeting problem, I'm still spending more than I'm earning every month by $1,000. I'm gonna be coming back to this a year from now, and now I'm not gonna be able to do it because I already took one. And now I'm maxing out my debt to income. See what I mean? So sometimes that can be the get out of jail free card. And it can cause problems. Other times, it's a great useful tool, right? Once we've fixed, whatever the issues are in our budget. And there's not always an issue with budgeting, right? Stuff happens, big life events happen, right? I'm a banker. I had both my feet reattached, believe it or not. So I had an accident, had to have my foot put back on, right? It's $100,000, right? A lot of medical bills, a lot of craziness. I was off work 6 months. Didn't expect that, right? We in the bank are people with financial problems too. We will never judge you for whatever situation you're in, right? So always feel free to talk to us. Like if you're like, hey, I need to fix this problem, whatever, right? Medical debt's a big one. 60% of bankruptcies are from medical debt. It's a big thing that happens. I see a lot of that. I see a lot of, hey, my husband died and he was the income earner and now I'm trying to keep my house, right? I see a lot of that where these debt amounts can be really small. If you lose an income, something happens. My kid went to jail. I see that one more often than you would think. My kid went to jail and I had to pay $20,000 for a lawyer for him because he's an idiot. I see that a lot. Stuff happens. And, you just never know. But, we hear a lot of cool stories.
I have a question about consolidation.
Yeah.
So so this one is something I'm actively trying to figure out. I am trying to find a consolidation loan to consolidate my two auto payments into one payment because my garage burned down and I lost everything in it a few months back, including both my cars. And so I had to buy two cars very quickly.
Oh, no.
And
Yeah.
so the interest rates, they're already going up.
Yep.
And the first interest rate was manageable. The second one was incredibly high because it's like, well, you just borrowed $25,000. Why are you coming back to us for more? Where it's like, both my cars burned down.
Right.
And so I'm finding, I've been shopping at credit unions and banks. A lot of the ones I've spoken to, like Key, Kemba, Fifth Third, they say, oh, we don't offer auto loan consolidation. So what do you do if you can't find the particular loan product that you want?
You might want to go and look at an alternative means of financing, which we'll talk more about. Sometimes, you want to go to someone who specializes in that type of loan. So I will tell you, a couple years ago, Key was the number 3 bank in the auto loan space. We did a lot of indirect lending with auto companies, right? We were the top choice. We were pretty much everyone's first choice when it came to auto loan lending. We sold it a couple years ago. Okay, so we're not in the auto loan business anymore. So my rates may not be as great as a bank that really specializes in those auto loans. Some credit unions, that's really their bread and butter. That's where they make their money. They're better at the auto lending than we are. For certain types of loans, you kind of got to shop and whatever bank is offering the best. So you're doing the right things by shopping.
I
But
guess it's with that, it's like you were talking about like really difficult situations where it's like life happens, bankers are people too,
yep,
where it's like I had to buy two cars very quickly and it's like they charged me a much higher interest rate on the second one.
Yeah.
Like, well, your debt to income just shot through the roof and now you want more money, where it's like,
Yep.
I'm like, I just lost both my cars.
yep.
And not, so it's especially, it's.
And here,
difficult.
and here's and we'll definitely, actually for everyone, there is a sheet here. And definitely if you want to have a one-off conversation, guys, give me your name, email, we'll set a one-on-one. If you're in the chat, just name, email and what topic, right? Name, email and what topic you want to talk about. I will reach out to you after, and we can definitely talk about it. Because every case is so individual. And I will say one thing that gets people into trouble with auto loans is, what's the difference in going to a bank for an auto loan and going to the dealer and for an auto loan underwriting wise? Does anyone know?
They send your credit to like 100 different banks, so they could give you, depending on the bank, they might get a kickback for a certain bank.
Correct. They have relationships with banks, right? So auto dealers sometimes will have a relationship with a bank where they'll say, hey, I've done 54 loans for you. I know this guy doesn't qualify, but make it happen because I do all this business with you, right? Sometimes auto lenders do have that special relationship. The other thing that auto lenders don't have to do, when you're at the dealership, they don't have to check your debt to income. They just go off what you say, right? So debt to income on auto loans can really get people into trouble, especially when you're trying to buy a house. It's almost cliche at this point that, real estate agents, anyone in the mortgage business, mortgage underwriters, they've all seen, clients real excited to get this house. Client knows what the payment's going to be. Client goes out and buys a new car and their debt to income is shot, right? Because to buy that car, they don't check your debt to income. We're checking debt to income when you go to do a consolidation loan, when you go to get a house, stuff like that. You have to be really careful with those auto loans. You really do. And I always tell people, stay away from the auto loans, especially when you're trying to do other types of financing. Of course, in your situation, what are you gonna do? You have to have a car,
You get
right?
Interest rate lower. So
Right.
One payment at a lower interest rate.
Then both, right?
Yeah, like since then, it's like multiple credit cards are paid off. It's like, but no letters like, oh, we don't offer that. With,
Right.
like, it's like, oh, you would be worthy, but we don't offer. that.
Right. Right. And some banks don't care, right? So some banks care about what the age of the vehicle. So for example, at KeyBank, right, which right now I'll tell you guys, I'll be upfront and honest with you guys. Unless it's a parking or parking lot sale or of like a friend's vehicle, I don't recommend using us for auto loans right now because my rates are not the most attractive, right? If you're gonna go buy a brand new car, probably do it at the dealer because you're gonna get a better rate. If it's a used car and you need to get financing that way, I might be better in that situation. The big thing with auto loans too is we got to worry about the loan to value of the vehicle. There's banks that don't even care though. Some banks will go way over the loan to value. They're like, hey, I'll loan 150% on that car. I don't care. And some banks care about the age. So for us, we care about it's either got to be less than 7 years or it's got to be classic, right? So it's either got to be a 55 Chevy or it has to be, within 7 years.
So the car breaks down, you lose all your fun.
Yep, exactly. Yeah, so, and keep in mind, an older car breakdown is more likely, and if breakdown is more likely, default is more likely, right? So the older the car, a lot of times, the more expensive the rate will be. So a lot of clients, I tell them, hey, maybe go get the newer car because you might save enough in interest that it's worth buying the new one versus the 2-year-old one. And especially right now, do your math on that because the car market's nuts. Let's see. But overall, I will say the big thing with consolidation, again, the takeaway, if you don't fix the underlying problem, this is not the solution, right? This is the get out of jail free card. It only works one time. Option 2, most likely for success. Option 1, if you're very diligent, I'll say I advise clients on option 1 when I know that they're very diligent and they've had a lot of success with budgeting planning in the past. I'll use option 1 because it does make the most sense from an interest standpoint. Any questions before we move on? How does a line of credit work? Who can tell me how a home equity line of credit works? Yeah.
That's you borrow money and if the collateral is the lender now owns a portion of your house.
Yeah,
That they get a lien where if you try to sell your house, you have to pay them first.
exactly. Yep. Does anyone have experience with an unsecured personal loan? Unsecured personal loan, this would include any type of consolidation loan you would typically do. So an unsecured loan would be something that we are not holding any type of collateral, right? It's just, we're going off your word and your good name that you're gonna pay it back, okay? Low interest credit cards, okay, we all know how those work. Many offer a 0% introductory offer. How many of you have used a 0% offer? Okay, got a couple hands, okay. How many of you have been burned by one of those offers? Just out of curiosity. Okay, who can tell me what we need to be careful of when we're taking a 0% offer on a credit card?
Make sure you pay it in full within the introductory period and you still, just because they say the famous cash. Like, oh, I'm not getting charged any interest for 6 months, you still need to make minimum payments, even if you plan, like, I'm gonna pay like 5 months, 30 days, I'm paying it all in one sum. You will be charged fees if you don't make the payments every month.
So same as cash is a good buzzword. What do I need to be careful of if something says same as cash? Anyone tell me?
So you get paid off that many.
Or what?
All that interest will be retroactively billed to you.
Correct. And this is a big thing that people don't know, okay? A lot of times when they get into these same as cash deals, right? They say, oh, it's 0% for 12 months. I think, okay, well, if I paid it down to $100 on month 12, I'm only gonna pay interest on $100, right? No, there are some cards out there that will backdate your interest to the day you took that credit card out. My favorite place to go and buy fun things, Best Buy, is this way, right? If you take one of their same as cash offers for 12 months, okay, let's say I take it January 1 of 2023 and I took out $1,000 and I owe $50 on January 1 of 2024 and I'm out of that 12-month window. They charge me interest 31%, 31%, by the way. Yeah, I actually looked it up over the weekend, what their rate is today. It's 31.49, something like that. 31% from January 1 of last year. So they go back and they charge me all that interest, okay?
Aren't most retail credit cards like offered at retailers like that?
Frequently, yes. So if it came from JCPenney, if it came from a Best Buy, something like that, it's probably that way. Not all of them do that. Most of the bank ones will not. Some of them do. So it is just fine print you want to be careful of. I can say I do not have a card that does that. Thank you, Key, right? Appreciate us not being scalpers. Saves angry people in my lobby. So anyway, the 0% offer, I will tell you at Key, when I talk about a low interest credit card being the solution, this is when someone doesn't have a lot of credit card debt. If they maybe have 2 pesky cards that they can't get rid of or something like that, I typically go with this option. We do have a 15-month 0% offer, so free plug for KeyBank. And we do not backdate interest like that. So let's say if you have our card, you're on month 15, you still owe that $200. You're paying interest just on that $200. So which one of these is the highest expense interest wise? You can tell me. Unsecured personal?
I'd say the same thing, because the lender is offsetting the risk by charging factor interest.
Yeah. So a home equity line is always going to be your cheapest interest. House loan followed by a home equity line. Why is it the cheapest? Right. Can't hide it in the woods. I can find it, right? No one yet has moved their house, right? That I haven't been able to find it if it was a problem, right? Now, unsecured personal loan, why does that get a little bit expensive?
Because they have to mitigate the risk.
Right, I have to mitigate the risk, right? I have nothing to come back on this. At least if you owe on a car, right? A car is not like a house. A car can be hidden, and it does happen, right? People hide their car in the woods and then we never see it again, right? But you can't drive that car comfortably knowing that the repo man's out there. The bank knows this, right? And we don't want to, here's the other misconception I'll say. Banks are not in the car business. We're not in the house business. We don't want your stuff. I promise. Promise we don't know what to do with it. We fire sell it. We don't get any of our money back. It's more time and hassle than it's worth. But here's the thing. Most people are going to make their car payment because they know they need that car to get to work, right? With the personal loans, unsecured personal loans, we get into a little bit more risk for the bank because the fact is if you don't pay that, what changes? Nothing. Nothing. We just don't get paid. The only thing that this comes back on is your credit score, right? So at the point that a client's starting to really struggle, this is the first thing they're not gonna pay. And we know that, right? That's why it's gonna cost a little bit more to finance it, right? Whereas if you have home equity, we know that's getting paid first. Everyone's top priority is keeping their house, right? That's gonna be the first on your priority list. We know that, you know that. So that's kind of the difference in the interest rates. So that's where I'll say low interest credit card, if you're on an introductory, is lower. Typically, a credit card today is 21 to 25% is typical. Some cards are as high as 31.49. So 30% is insane to me. Credit cards have gone up a lot in the last 2 years, like a lot. So I'm seeing a lot of clients coming to me. They're like, hey, my payment used to be $100. Now it's 300, right? I can't afford this anymore. Getting a lot of that. What's the other big benefit of a personal loan? Let's say my interest rate doesn't change. I get rid of my credit cards, but I get a personal loan. What's the big benefit there? Let's say interest rate's exactly the same even.
Fixed, it's budgetable.
It's fixed. It's not gonna change on me every month. My minimum's not gonna go up. It's not gonna change. It's gonna be the same payment until it's done, right? The other thing is I'm not making 5 different payments to 5 different places. I can time my payments more effectively. I can budget my month better. Okay. So. You sure can. Sure can.
That'd be more
Mhm.
like attractive to the lender. 'Cause it's like, you're not making any payments, so you're more likely to make this one.
It is because
That might be legal.
That'd be great.
it sure does. So if your home is paid off. So for those of you on the call in, the question was, with a home equity line, with the home equity line, if the house is paid off, can I still take the equity line and is my rate lower? And the answer is yes, it is. So with an equity line, if it can be put in what's called first position lien, which means that, essentially the bank is the first one that gets paid back if they're in first position. It means that if you were to default on that house, any proceeds from the sale of the house come to the bank first, right? So typically people have 2 mortgages. Most commonly, people will have a first mortgage and they'll have an equity line, right? First mortgage, if it gets paid back and the sale of the house, then the second lien will get whatever's left over. Banks will commonly go up to position 3. We'll only do that in special circumstances. Typically, first and second lien are the most common. So most people do have 2 liens. It's very common. There is not a client I would advise to not have an equity line. It just makes sense. It's just a great product to have. Let's talk about it a little more, actually, I guess, because that's a good one to talk about, because it's a great way to get out of debt as well. Who's had an equity line that they've used? So, what's one of the big benefits of it?
I think it's a bank key anyway, so it's just something I can monitor. And if there's, if you gotta pay your taxes or you what I use it for is home improvement projects, like, if you're doing a deck or just general home improvements. It's something I can monitor, and then I can transfer money out of savings and pay it right off,
Right.
and it's interest only.
Mhm.
The way we did it, it's an
Mhm.
interest payment only. Now you can pay more on the principal too, so.
Right.
If you want to go 6 months and just pay interest on what you're doing, then you
Right.
can do that, but it gives you lots of different options. It's visible, and it's just very convenient.
Right. Number 1 is flexibility. You have access to the cash right up front whenever you need it. If you only need it for a week, you only pay for a week. You can use it, pay it back, use it, pay it back, use it, pay it back. Equity line at Key, you have no closing costs, costs you $50 a year to have one. It's a great deal, right? We pay for the appraisal, we pay for all the stuff. $50 a year, you got a line of credit. Who can tell me how much of your house you're generally able to take on a line of credit?
About 10%.
More, yeah. How much of your total house value can you typically take?
But like flat dollar amount.
No, not flat dollar, percentage.
8%?
80?
That's my guess.
80's right. Yep. So 80% is commonly what we'll go to. Okay. So there's three ratios I'll give you guys when you're looking at financing. Okay. 45% debt to income. So your payments for the month can be up to 45% of your monthly of your 45% of your monthly income can be for payments that the bank will accept. We'll go to 50, but we don't like to. And we'll charge you a little bit more if we have to. 45% debt to income, 80% loan to values is what we're looking for. We only ever want to finance 80% of something's value. That's the gold standard for banking, right? Sometimes we'll go to 90 again, exceptional client, exceptional credit profile, we'll go a little higher, but 80% is where you want to be typically. So if I have $100,000 home, just for round even numbers, I wish you could find those still. $100,000 home, right? $80,000 I can take out. Okay. So if I have a first mortgage and it's $40,000, okay, that means my equity line can be $40,000. Okay. So that's a great point. Equity lines are great for the flexibility. They're great for cash flow because you can make that interest only payment. So maybe I want to take 6 months and remodel my house and put all my cash into remodeling my house and make a small payment for that 6 months because, you know, maybe I can pay for that new front door if I'm not making that big monthly payment, right?
Can you use if you want to consolidate other loans?
You sure can. You can use it for anything. The only caveat I'll say is if you do use a home equity line, I never advise to use it on a student loan because again, we'll get into student loans, but student loans follow you. And also if you use a home equity loan to pay off a student loan, it kind of has the same rules will apply because you used it to pay off a student loan. So it kind of incorporates student loan rules into the home equity. So that's the one that I'll say. Unless it's a very manageable amount, I say don't put it on the equity line. But for the most part, if you go to buy a new car, you can put that on the equity line. If you go to buy, right, if you go to buy anything, basically, if you need to pay off credit cards, you know, son went to jail, you need $10,000 today, you can use the equity line. It's access to cash right away, which can be dangerous, right? If there's a symptom, if it's a symptom of the problem is the debt, right? Like if you have a budgeting problem, this is not the product. Maybe I would be like, don't use this. But it's a great financial tool. I'll tell you, I advise every client to have one. Doesn't matter. I've got clients with $50 million in the bank. I kid you not, $50 million in the bank. They will take one of these out on their house. It's that useful of a tool. The fact is that you can use it, pay it off. The other thing is there's some tax implications of on a primary residence, you're allowed to deduct a certain amount. Now I'm not going to get into that because I'm not allowed to because it's kind of tax code stuff, but it's the most tax advantageous and lowest cost thing you can do. So let's move on. Okay, so let's talk debt consolidation, okay? So let's say I'm gonna take credit card 1 and credit card 2, right? They have different rates. Which quick plug, key.com has a debt consolidation calculator that's awesome. You can put all your stuff in there and then put in what your proposed debt consolidation is, and it will spit back what you're looking at payment wise and if it's relevant to do it. So let's say auto loans 8.5. Credit card is 21 and credit card 1 is 18, credit card 2 is 21 and auto loan is 8.5. Okay, a lot of clients will raise a big objection. They'll be like, hold on, whoa, I'm not going to take my 8.5% auto loan or my 4% mortgage and roll them into something new that's a higher rate, right? Why would I do that? Why would I take my 8%? Let's just say for terms of the example, let's just say it was going to be a 10% loan. Why would I take my 8.5% auto loan and make it 10% for the consolidation? Anyone have a reason that you might accept a higher interest rate?
Shorter term.
Might be shorter term, okay?
Yeah, look at all of it holistically. You can't just pick and choose. It's all your debt.
Yep.
So when you look at the other two rates, credit card 2 is going to accumulate the fastest as far as interest.
Yep.
Principal.
Yep, and guys, right now, I'm seeing a lot of this where I owe 20,000 on my house at 3% because I got it when the rates were great, but now I have a bunch of credit cards charging me 30%. Okay. Sometimes it makes sense to take that house payment from Okay, it's at 3%. Let's take it to 6 or 7%. Okay. Why would I do that? Right? Because that sounds terrible to do, right? Take my interest rate from 3 to 7% on my mortgage. Well, if I've got this credit card that's $20,000 charging me 30%, it's costing me more than the 100,000 on my house that's charging me that 3%, right? So sometimes and again, debt to income issues come up, right? What if this auto loan payment that's 15,000, what if that payment's $400 a month? And I'm right at 45% debt to income, right? Sometimes it makes sense to pay that off from a debt to income standpoint so that it allows me to consolidate all my debt. So sometimes we have to do it just for cash flow. Sometimes we'll have to eliminate something like a car payment to make the cash flow better, to make the deal work. Because again, we're trying to get you under 45% of your income going to your debts. Okay. When you really think about a budget for a month, out of 100% of your budget, 50% should be your needs. The bank's pretty in line with that. 50% should be your needs. 20% should be short-term needs, or short-term wants, I should say. 20% should be short-term wants, right? Like I want to buy new clothes, I want to buy a new whatever, right? Want a cool car, stuff like that. Stuff that's not necessary should be about 20%. Another 10% should be miscellaneous, and then the last 20% should be either saving for the future, right? Saving for a future goal, or getting my debt paid down, right? So when you're thinking about your money, that's a good general way to start shooting towards a goal. Any questions here before I move on? Validation way. So just to let you guys know, anyone that wants to, again, there's a sign up sheet up here. Anyone that wants to have a one-on-one conversation, please get your email on that form. We'll get a banker to schedule an appointment with you. We do virtual appointments. We're in person at Stringtown. I will say for everyone that's within a radius of the Stringtown branch that you can comfortably make it to open an account in person. You all do get a key at work offer through the QR link that's going to be in the end of the slideshow. But also any of you that are local, the Stringtown office does have a $300 offer to sign up. Just throwing that out there. All you got to do is get direct deposit with us. So you can schedule, if any of you want to come up and see, we can give you resources. We can do the budgets with you. We can take a look at your debts. You know, if you want to make a plan, just come and see us. And again, we have seen everything. We are like doctors in some ways, right? Like we have seen all the situations. We are never going to call your husband or your wife and be like, hey, that credit card, you know, you need to tell them to knock it off. You know, we are not going to tattle on you, right? I get that a lot, right? Like I've done home equity lines and then had the spouse show up and say, please don't tell him about this, or please don't tell her about my Jags card, you know? I've seen that come up. We're silent, right? We don't ever bust anybody out. So if you need help, please reach out. So some student loan fun facts. Here's the student loan portion, I promised. According to Forbes, Ohio's average student loan debt is $33,490.59. Who feels like that's feels wrong, right? It feels wrong because it's an average. So because a lot of people either owe 8,000 or 9,000 and a lot of people owe 70 or 80,000, right? So it's an average, right? So this is probably not the real number. It's kind of wishful thinking, but that just goes to show you statistics or whatever people want to make them. 3.1 million, and this is as of, I pulled this on Thursday, I believe, off the Forbes site. So 3.1 million borrowers are in deferment, 24 million are in forbearance, and 5.1 million are currently in default.
Is that in Ohio?
This is, no, I'm sorry. First one is Ohio stat, second one is a national stat.
Yeah.
92% of all student loans are federal student loans. And student loans follow your estate. Who can tell me the difference in deferment and forbearance? Yep. Kinda, you're getting closer. Thank you, A for effort. Let's get her a card. Yes,
So it's like they're kind of put on pause, but you know that you're not gonna pick it back up.
yeah, so
You're deferring the interest, like kicking it down the road.
other way. Yeah, kind of, I guess. So deferment is, we're not gonna worry about paying this right now, but I'm still gonna charge you interest. So you don't have to make a payment right now, but I'm still gonna charge you every month, okay? Forbearance is what everyone had during COVID. That's, hey, we're gonna stop charging interest. We're just gonna pause this loan right here. This is just gonna sit right here and wait on you for a couple years, right? These are disappearing quickly. A lot of people are off their forbearance. Hopefully you are all in tune with your student loan situation. It can be very complicated, cumbersome, and a lot to absorb, right? Because you may have 10 different types of loans in your federal loan portal, right? It's very confusing. Reading the fine print is important. 92% of student loans are federal student loans, meaning, you've taken them out directly from the government in some way, okay? Student loans follow your estate. What do I mean by that? Anyone know? Even if you die, you gotta pay it back. They're coming. They are coming for you. They do not care. Fun fact, cable bills are also that way. Yes, I have seen many people sign up for Dish Network or DirecTV, whatever. And they have a clause in there that their contract follows your estate. And so here I've got to tell grandma that, grandpa isn't there to watch the TV anymore, but she's still got to pay grandpa's bill, right? It's annoying. And honestly, I don't get it. It's bad business, in my opinion, but they didn't have to. So it does follow your estate. Student loans also definitely limit your bankruptcy ability. This is, and again, the Dave Ramsey of the world, right? He's no bankruptcy ever. Never makes sense, right? Pretty much. I'm in a different camp, right? I think that there are times when it's warranted. There's times when it needs to happen. And it can really impede you with student loans, because again, they've got first dibs. They're basically first lien on your income. The government's going to take their money no matter what, right? The other thing with student loans, a lot of people ignore them for a long time, and then they go to buy a house or something. That's when it comes up, right? It's, I didn't make my payments and now I have this collection, right? And even when I get back on a payment, it's destroyed my credit, or it's showing this giant payment. It makes it hard for me to afford the house I want, that kind of thing. So you want to be very careful with student loans. This is also why I say don't necessarily use a home equity line to pay off your student loan. Because if you ever go to get out of it, like the home gets foreclosed on, and again, these are disaster scenarios, but like, let's say the house gets foreclosed on, or you declare bankruptcy, something like that, student loan rules apply once you've paid off that student loan with that home equity line, right? So
Apply to the entire loan.
they apply to the amount you used. So now in practice, is that always enforced? Probably not, because no one's probably tracking that, right? But at the point that if the creditor finds out, and there are certain creditors, we don't ask, but I do know some other banks I've worked for, they will ask in the home equity application, are you using this to pay off student loans? They will ask in the application. So again, it's something you want to be cautious of. It can still save you a ton of money. So, that might be worth it, but just know the implications of that. Here's a very important set of quick tips on paying down your student loans. Know your repayment plan and the implications of it. Okay, deferment and income-based repayment can be traps. Okay, why do I say they're traps? Anyone want to shout out what the problem with deferment? Loan keeps growing. Okay, I once talked to an HR rep that had been paying her loan for 50 years, and it had grown the entire time. She made payments every month for 50 years, and it grew. Yep. I've seen that a lot.
Isn't there recent executive action that's changing that?
To some degree, yes. So there's some income-based payments.
From getting to.
Yeah, no, actually, no, right? I've seen that a lot, where they've grown and people have been making their payments for a long time. Here's the thing, if you are in some kind of like social work, those are getting forgiven. I've seen a lot of those be forgiven lately. I've actually seen a lot of the people that have been on the income-based repayment for a long time have started to be forgiven, so that's happening, hopefully. Oh, okay.
Yes.
So yeah, some of those have, really started to be forgiven in terms of the people that have paid for a long time. So here's hoping if you're in that boat. Also, you want to make sure that you're not in one of those categories, right? You want to do your research and make sure that you can't be forgiven before you try and refinance out of your debt. You want to make sure that you're not somebody that's going to be, you know what I mean, be able to get out of it based on a government program. Because likely, if they're going to forgive a portion, you want to hang on for that, right? Pay more than your minimum and apply windfalls from tax returns, bonus checks, et cetera. If you're trying to get out of those, right? If you get that $5,000 tax return, right, and you apply that, do the math on that, because that might be really worth using that towards paying down your debts, right? Because on a month-to-month debt payment, right? Restructure and consolidate your loans for lower rates and better payment terms. Okay, another quick KeyBank plug. Okay, this is a company we own. It's called laurelroad.com. Anybody remember the Yanny Laurel thing that was viral?
Yeah.
Does it say, yeah. Does it say Yanny? That's how I remember. Okay. Where's the name come from? The name was the name when we bought it. Someone made it up, right? But we bought it. It had a strong brand. This is a company that specializes in paying down medical debt. They're very tech forward and we liked their systems and we applied it to our mortgage system. So we bought this company. What that means to you is if you're key at work and you have accounts with Key, you do get a discount on your student loans with this. So what this site specializes in is consolidating and consolidating student loan debt and giving you a fixed term. You can go on that website and plug in what you have. It will do a soft pull and it will give you some options. It's a great site to try. Again, not for everybody, but for a lot of people, it consolidates and it can give you some really good results. I've seen really great results on it lately, especially compared to what your government loans are charging you now. If anyone is interested in scheduling an appointment, again, we've got the sign up sheet here. If you're interested in opening an account online or doing anything online, you can also schedule appointments. Just scan this QR code and it will link you right in. Again, for anyone that's here local that can make it to the Stringtown office, feel free to take a flyer. There's a $300 offer right now. Does anyone have questions that need answered still?
Just so.
Yeah.
I've done. So I had a lease on a truck.
Uh-huh.
Way over miles, so I was kind of stuck having to buy it.
Yep.
At a high interest rate.
Yep.
And I qualify for a much lower rate now.
Mhm.
I'm building a house, it's supposed to be done in July. And I don't know if the hard inquiry, if I
Wait,
refinance now before that, that could affect that interest rate.
yeah, if it's not crippling you financially, wait.
Wait until.
Yeah, wait. The day you get your keys, come see me. And then you can,
Secondly, build a house in July.
Uh-huh.
Supposed to sell mine around May.
Uh-huh.
140, it'll sell for over 300.
Mhm.
In the case, it's not contingent on that home selling, but I don't need to crap out another 45 grand.
Oh, like you're on a bridge loan. Is that what you mean?
I don't know. If it's
Like
not
they're gonna charge you
contingent on-
40%.
Yeah, 10% would be minimum
Oh, got it.
due.
Uh-huh.
So if my house didn't sell right away, could I take out a HELOC and put towards down payment?
Yeah, as long as you have the new house already. You could pay off the old loan that you have.
No. I'm talking about take out a HELOC on my old house,
Mm-hmm.
use that for a down payment on my new house and rent my house out.
You cannot take a home equity line while your home is actively listed.
If it wasn't.
Yeah, so if it's not listed for sale, you can probably take an equity line, yes. Yeah. Once you put your house, and this is why I also tell people, so get it early. Like if you need a HELOC or if you think you might ever need one, get it now. Because you never know when those situations will come up where you're like, okay, I need to float this loan or I need to do whatever. Our lines of credit are good for 15 years. So you go through the paperwork, it takes about 2 months to get one. It's good for 15 years if you ever need it again. So great point, and like, you know, it's great to have when you need it, because once you list that house, you can't take it.
Isn't that a hard inquiry?
It sure would be, yeah, yeah. We do have a fantastic mortgage officer. If any of you have specific questions or you want to look at debt consolidation, that kind of thing. He's fantastic. His name's Todd Patterson. He couldn't come today, but I can definitely get you his contact. Just throw your email on there and let me know it's about mortgage or a home equity question and I can get him back with you on it. Yeah.
I have also a home equity question, that's all right.
Yeah.
So like I said, my garage burned down, lost everything in it. And I painfully learned about insurance policy maximums.
Yeah.
Because my garage was detached, that capped the benefit insurance could pay. And so I still need the garage because my wife works in real estate. She ran comps that within a mile of my house, similar homes that have a two-car garage and don't have a two-car garage, the difference in listing value is about $50,000.
Yep.
And currently, the numbers are close enough that if I don't rebuild the garage, that could put me upside down on my mortgage
Yep.
by dropping my home value by 50,000.
Yep.
But also, it's like, I need to build the garage, but insurance will only pay so much. We've considered getting a HELOC to help finance what insurance didn't pay.
Yeah, that's a great use of it. Yep, and you can definitely use it for garage. And matter of fact, how big was the garage?
So I think it's like 22 by 22.
Okay.
It's standard.
Good.
for attached garage.
Good, nice garage, right? My advice would be make it as big as you can when you rebuild it, you know? If you can widen it, extend it, right? I would say, talk to the real estate professionals in your life, but probably worth it to make that garage even bigger. Even if you gotta take out a little bit of money, a lot of times the 3-car garage can do a lot correct way, right? So again, I would definitely check into that. But yes, you can use a home equity for anything home improvement. You can. And insurance wise, definitely know what your maximums are. Another good quick tip that I learned because I got robbed and all my stuff got cleaned out one time. Take a video camera and just go through your whole house because if you're in the situation, I tell you, they are thorough. They took the food from my fridge. They took the sheets from my bed and they took my clothes. Why did they want my clothes? First thing the cop asked me, and
No, I.
yeah,
It was criminal law, so I'm just throwing.
oh, you were, yeah, and you know what? And
Must have shared that my garage burned, they said list everything in it. They said list everything that's in there. As long as it's less than $1,000, we're not gonna ask for it. It's more than $1,000 we need.
yeah, and I'll tell you, I had a good insurance company at the time. They didn't ask me any questions at all. I sent them the list. They replaced it. Right? They didn't care what I replaced it with. I had full replacement. So 2 things you want to ask with homeowners. And make sure you have full replacement value. Okay, make sure you don't have just the item's value, right? Because that really cool Samsung LG TV that's top of the line this year, well, next year it's worth half as much, right? So make sure you have replacement value, not actual value, because I could go to Best Buy and buy the new model for the same price that mine's worth today, because it had a year of use on it, right? Make sure you have a replacement value. The other thing on homeowners insurance that I've been telling everybody to check out, there is a fraud policy you can add for not a lot of money, which is like someone hacks my accounts, takes my money out, or tricks me into a scam, gets me to buy a gift card or something like that. They actually cover that on your homeowners now. So ask them about their fraud insurance policies. They are pretty reasonable from what I hear. I had one client that had fake wire instructions, wired out $30,000 from his account. Someone hacked his title agency. He's on the hook for that 30,000. His insurance covered him luckily. Luckily, so I've seen situations like that. So definitely a good insurance agent conversation. And then there's policy maximums, right? Jewelry, guns, there's always a max.
Get a personal article policy.
Yeah, make sure that you tell them what you have and make sure that you document what you have. Take that video and I'll tell you from experience, you will a year later forget that you had that thing. And it's too late to call the insurance and be like, hey, I had that thing. And when you paid me that settlement, we didn't include that
Yeah,
thing, right?
I'm running into that now, and our adjuster's like, it's technically about 2 years to claim something, but they said the underwriters are gonna say the further time that goes by, spend more higher, the less likely they are to agree to it.
Yeah, the more scrutiny they'll have. So what I always tell people is once a year, just go through your house with the video camera, open every door, right? Document what you have. Because again, they take everything. So weird. So weird.
Let's talk with you. How much is like, if you open up a savings account, just a regular one, I know it occurs some kind of interest throughout the year. How much is yours?
All on a savings account.
Yeah.
So, if we're talking savings account, not much until you get to the 25,000 up range. If you put 25,000 or more in a savings account, you can usually get a pretty great interest rate right now. On a CD, I believe 4,000 up is where the rates start getting good if you do a CD. We have some shorter term CDs that are like 8 months that are really good rate. So I'd look into those. Yeah, CDs, they've been gone, right? They've been.
VHS, got any VHS?
I know, VHS, I don't know, VHS. That's what it feels like though, because I went through probably a 3-year period where I didn't touch a CD because they were garbage. And today, like, hey, if you can get a good 4 or 5% CD, do it.
Oh, I'm sorry, because I've been reading some articles on how to invest your money. So high yield and savings. What's the difference in just a regular savings account? A lot of people are saying CDs, which are into that. They also said put it into a high yield savings account. What's the
Yeah,
difference?
so let's talk about that. So, there is what's called a high yield savings, or it's called money market, right? There's a lot of confusion with money markets, because there are money markets on the investment side where everyone is actually at risk. On the bank side, if you open a money market, it's typically FDIC insured, if you open it with the bank. So there's no risk, right? Now, a money market typically is a higher balance account that pays a higher rate.
Okay.
So you have to put a higher amount into it.
So for instance, the 25,000 you were just saying, if I put that in there, and it's it.
You're gonna get a higher rate.
Okay, what is your rate at KeyBank?
They come out on Mondays and we get started, so.
Is it in the- is it in like the
It'd be the fours.
It's in the fours. Okay, you got that. Yeah, okay. No.
I can check it.
Okay.
But if you want to get- I think that might be, or figuring out the list, you know. The, certificate of deposit is, kind of antiquated. I mean, they were really big in the 80s, really big in the 90s, and then they kind of went away for a long time, now they're coming back. Those are FDIC insured, there is no risk to them at all. Because they're backed by the FDIC, even if the bank goes belly up, you're getting paid, right? To a certain amount, right, up to 250, yeah. If you're in that situation, by the way, I do a whole class on FDIC. Even if you have millions of dollars, I can find ways to get you covered. So if you have that problem, I will help you. If any of you have millions of dollars, you need to make sure it's FDIC insured, we got you covered. But yeah, standard runs to 250. Certificate of deposit, you're just basically putting your money up for a locked in amount of time. So you might say, you know, I want 8 months or 11 months, I think, are special right now, but you just say, hey, I can't use this money for 8 months or 10 months, 12 months, whatever. Right? And then what happens is it's at the end of that term, and it's due, and you can either renew it or take out. Okay. I'm sure we're probably spending a little bit. Any other questions? I mean, I've got all day. Well, Kyle, I was thinking. On your guys' time.
Thank you, everyone, for joining us.
Hopefully that's helpful. Again, feel free to email.
Thank you.
Thank you. If anyone would like, please send me your email. I'll be happy to make sure